Okay, we've got a good number of people on now, so thank you very much for spending your Tuesday. I nearly said Monday. So easily done on a bank holiday week. I nearly said Monday, but here we are on Tuesday. Thank you very much for spending Tuesday afternoon with me. Let's get into this webinar straight away. This is a sourced HMO partner presentation. So first of all, who am I? Why am I speaking to you today? My name is Chris Kirkwood. That is a picture of me, and the picture is a good thing because we can obviously update the picture and use all kinds of technical jiggery-pokery from the marketing department rather than you looking at a video of me. That is a very polished image of me right there. So I'm the franchise director for Sourced. Before I started with Sourced, I had founded, run and grown my own businesses in a number of different sectors. And then I generated a bit of cash flow from those separate businesses, and I looked at something to do with that cash flow. And like everybody in the UK, I think you innately know when you are born that property is an interesting thing for you to put your money into. And so I started looking at property as a more secure investment in relation to other investments that I could put my money into. And I've been investing in property for over 10 years now. And my involvement in property has been from about £55,000 was the cheapest property that I ever bought, up to about £150 million worth of GDV value in some of the deals that we're involved with at the moment. Through those deals, and there have been many, I've executed many different property strategies to build, to grow my own portfolio, to add to my own cash flow. Lots of different creative ways of solving that problem of how you make money out of property. And now what I do is I oversee all franchise operations, and that includes looking after about 150 franchisees. And part of what we do at Sourced is we oversee the franchisees' deals, and we help them see the deals in the most profitable way that they possibly can. And they might bring a property to us, and they might have an idea as to what to do with that property. But then what we can do is we can rejig the way that they're thinking about that deal, or the way that they're structuring that deal, or even the way that the property is structured itself, in order to make that deal more or as profitable as possible. So even though I've been involved in lots of property deals in my own portfolio and with my own investments, I now have exponentially more deals that I'm looking at helping with, supporting, structuring with our 150 franchisees across the country. Because what we're here to do is we're here to get deals done for our franchisees. That's the purpose of Sourced Franchise. Our main operation is to help franchisees find deals, assess deals, structure deals correctly in a profitable way, and get those deals done. So Sourced as a business, funnily enough, as you can see here from the second one that I've just clicked on, our franchise model. So the franchise started in September 2017. So actually tomorrow is our 4th birthday. The concept of Sourced started before September. The concept started in January of the same year. But all the necessary background work was done, and the franchise was actually launched in September of 2017. Further on in the next year, we received FCA approval in order to run our peer-to-peer lending platform. And while we were looking for that financial aid for the franchisees, we were still growing and increasing the franchise. So the franchise hit 50 people in October 2018. So really quick growth we experienced here. And the reason that we experienced quick growth is because we do something that other people don't do. We put together everything in one package. I'll tell you a little bit more about that at the end of the presentation, how it all fits together. We then have been doing our own developments because we're not just the kind of people that have done property years ago. We knew what we learned what we needed to learn in the background, and then we stopped doing it and we started running the franchise. We still do property. We are involved in property. We outsource absolutely everything that we do in property in order to give Sourced our full time, but we have been involved in lots of different, and still are involved in lots of different developments to this day. In January 2020, we the money raising side of our business, Sourced Capital, registered for ISA and pension funds, and in October 2020, we started Sourced Care as an add-on to the main core of our business. We've hit 100 franchisees, and actually tomorrow, or the day after, should I say, we are launching our phone app. So it's all about growth. It's all about improvement. It's all about evolution here at Sourced. Something that I should have said at the beginning, which I always say at the beginning, and I've forgotten to do it this time, is just to say that in the menu bar that you've got a chat area and a Q&A area. If you've got a question for me at any point, please put it in the Q&A area. If you put it in the chat area, it's just like a fire hose. It just the latest person to put something in the chat just goes to the top and everything else pushes down. So I might miss your questions if you put it in chat. However, if you put it in the Q&A section, I have to see that before I can then go on to the next question. So please make sure if you've got any questions, you put it into the Q&A section, not the chat section. So at Sourced, we've got 5 different parts to the business. Now, the core of our business is actually only 2 of those parts. The core of our business is the franchise operation, and then it's Sourced Capital. The franchise operation, like I said, helps and supports and guides and advises franchisees. And then the Sourced Capital is the money-raising peer-to-peer FCA authorized part of the business. And what they do at Sourced Capital is they raise the money in order to fund the franchisees' deals. So, like I say, we've got an in-house full 360-degree service where we help you find the deals, we help you analyze the deals, we help you structure the deals properly, we help you get the deals through so that you're actually going through the conveyancing process. We make sure that you've got all the right agreements in place, and then we go to funding, and we can also fund those deals for you. Again, there's more detail obviously involved in that because that's a huge process. I'll cover that at the end. So what we're doing in a general month here at Sourced is we're looking at and analysing around 2,500 property deals. We've got over 100 franchisees. In actual fact, to be absolutely specific with you, we've got 161 franchisees. We've got lots of different strategies that we can help franchisees operate. We're not saying that if anybody joins us as a franchisee, that you are limited to only doing one kind of thing forever. And we are operating and understand that the different ways of operating and the different ways of getting deals done across the UK. We're not limited to one geographical location. Last year, we raised more than £10 million for our franchisees' deals, and we've got well over £1 million worth of deals in the pipeline right now that are going to require funding within the next 4 weeks or so. We're also working with investors from around 69 countries. But what we're talking about today is HMO versus serviced accommodation. And this is a question that we get asked a lot. I'd say that they're probably the 2 most sort of fashionable, most well-known strategies, especially over the last 12 months. HMO has been popular for a while now, but it is still a very, very popular strategy. It's not something that became popular and then sort of waned in popularity. HMO is still something that's very popular, and serviced accommodation, SA or holiday lets, you might call them, were very, very popular. They were sort of the new up-and-coming strategy before coronavirus, and then they got a lot of press over the coronavirus pandemic because the serviced accommodation business was pretty much completely shut down. When movement was shut down, when holidays were shut down, serviced accommodation suffered possibly the most out of all the different property strategies. So let's look at the definitions and let's look at exactly what a HMO is and exactly what serviced accommodation is. So a HMO stands for a house in multiple occupation, and it's got multiple occupants. And instead of renting out the house as like a normal buy-to-let would, you're renting out the rooms individually. And if you're renting out the rooms individually, you might or you might not have en suites in each one of those rooms, but you probably haven't got kitchenettes in each one of those rooms. So you've got a lot of shared facilities. There's higher rental income because you're charging each person by the room. And generally speaking, the landlord would pay the bills. So it's very easy for that tenant to move in, very easy for that tenant to move out. Everything is covered under one payment that they pay per month. And you've got lots of different markets that you can fit in for HMO. So probably the best known is the student market. When people go to university, they're usually living in house shares. And that's basically the structure of how you keep your costs down when you're at university. But HMOs are becoming much more popular in different markets as well. So you've got the LHA market, or the local housing association market. So some people will, the most appropriate housing for them, for the local council, for them to pay for them to be in, is a HMO. because it costs the council less money to put more people into one property. But even now, you've got the professional market, where people come out of university and the first houses that they want to get into would be HMOs, because again, it's keeping the costs down. Now, what is necessary for the LHA market and what is necessary for the professional market would be completely different from one property to the next. So that needs to be thought of. But we'll get into that a little bit more. Now, one of the stats that we work with a charity called Centrepoint, and they help people that have been in the care sector as children. They help house them. They help get on their feet as adults, because often there's a lot of help and support for children, but then as soon as you become an adult, then you're out there and you're taking care of yourself. Well, Centrepoint sort of bridged that gap to help people find their feet. One of the statistics that Centrepoint told us was that they're expecting 75% of under 25-year-olds to be housed in HMOs by 2025. So one of the things that people are always worried about with HMO is whether the market is saturated. Now, I've just told you about three different, very, very different markets for HMO. You've got LHA, you've got student, and you've got professional. So you need to look at each one of these markets very separately in order to make that assessment. But 75% of under 25s living in HMOs is a huge number of people. And I think there's only in very, very specific parts of the country that you might say that market is reaching anywhere near saturation. Obviously, one of the benefits from HMO is that you're earning a higher cash flow while you're still making that capital value appreciation, because you own the property. Now, as you know, the price of property has gone up and is predicted to go up over the next few years. You know, especially over the last 12 to 18 months, we've seen a huge amount of capital appreciation across most of the country. Now, with HMO, you are making a higher cash flow and you're still making that capital appreciation. So it's like a double whammy. In many parts of the country, people had been, when you're looking at normal buy-to-let, you're looking at either making cash flow. For example, in the Northeast, you can make fantastic cash flow, but you're sacrificing your capital appreciation. And that's just a historical average. And it was exactly the opposite in the Southeast. So in the Southeast, you're probably going to make more capital appreciation, but then your rental yield or the rental income that you're generating would be a lot lower. HMO helps to bridge that gap. So you can now look in the Southeast, in the areas where you know the high capital appreciation is going to be, and you can make a higher cash flow. Obviously, investment is secured against the asset, so you've got that asset-backed investment, and the property market is fairly stable in comparison to other markets where you're going to put your money. For example, the stock market. The property market is much more stable historically than the stock market or other investment markets. Let's look at Bitcoin, for example. What you can also do with the property is you can add value to that asset and force that capital appreciation. So one of the things that I particularly like about property is that you're in control. If you want to spend the minimum that you possibly can in order to just make that money every single month, then you absolutely can. If you want to put some money into the property and upgrade the property, then you're going to be rewarded for that, because if you've done your homework right and you've bought in the right areas, that means that you'll make that capital appreciation and you'll be rewarded for the effort that you've put in. So essentially, HMOs give you growth and they give you income. Now, the conveyancing process for HMOs can be fairly slow, especially if you're purchasing as a HMO or you want to complete with it as a HMO. And there's different structures, there's different strategies of mitigating for this. And certainly when it comes to making that higher GDV, that higher end value, there are many ways that you can go about that. But you need to be well versed and you need to understand what your options are and what the best choice would be for you and the property, because a lot of the time it's not just about the property, it's about your circumstances and what you want to achieve as well. So HMOs give you a high stable cash flow. You can create the capital uplift, or certainly you're much more in control of that than you would be from other investment opportunities and managing agents. And you can find different people, different managing agents to free up your time. We just had a handyman in the office this morning and he looks after a portfolio for a landlord. So as soon as something is reported to the landlord, it basically gets passed straight onto the handyman sorts it out. So the landlord doesn't have to go around there, see if they can do it themselves. But then you've got letting agents as well who can help you free up your time. HMO can be trading in a short period of time. So if you're looking for return and you've been thinking about conversions or you've been thinking about new build developments, to turn a normal property into a HMO can be a lot easier, a lot quicker, a lot cheaper than it can be to build a new house or convert a commercial property into residential. So if you're looking at being as efficient as you can possibly be, HMO is a very good option for you. And as we've discussed, you've got 3 different types of market that you can get into. So you could even start off in one market and flip to another market if the circumstances in that area changes and one market, say the professional market, becomes much stronger than where you originally started out. Options and a plan B and a plan C for you. So now looking on to serviced accommodation. So like I said, this is sort of termed as holiday lets. That's what most people will understand serviced accommodation to be. But really, it isn't just holiday lets. And actually, if you're thinking that it is only holiday lets, you're missing a huge part of the market. Holiday lets are fantastic, but I know people that own holiday lets in very, very popular destinations around the country. And their demand is incredibly high in school holidays. And outside of those school holidays, or during the week, for example, outside of school holidays, that's where generally the demand will be less strong. So what you want to be looking for is you want to be looking for areas that not only have that leisure market, but also areas that have that commercial market, because there's a huge amount of demand from the commercial sector for holiday, I'm doing the air quotes, for holiday lets or serviced accommodation, to be more accurate. And in the commercial people, what they're looking for is they're looking to reduce their costs. Because if you can imagine, a business is going to fly in 2 different people from across the world, different parts of the world, and they're going to have them based at their head office for a month. Now, those 2 people would have their own hotel room each. And let's say that their own hotel room costs them 150 quid a night, so 300 quid per day for those 2 people. Now, you might have serviced accommodation in the same area, and your serviced accommodation might cost £220 per night. Now, you're saving that business a huge amount of money, but they're taking a month-long booking with you. And so everyone's a winner from that business having the option of serviced accommodation in that area. So it's not only the leisure market, it's not only the holiday lets market, but it's also the commercial market. And you need to be aware that that is a very, very strong provider of your rental income for serviced accommodation. Now, because you're selling those rooms per night, or because you're selling that unit per night, you've then got a higher rental income. And in fact, with serviced accommodation, you've got the best chance of making a lot more money than you could from, let's say, a buy-to-let or from HMO. However, because you're selling per night, it's much more important for you to be involved in the business, or to have somebody running the business who has the same desire for you to keep your occupancy high. Because every single day with serviced accommodation, you need to work on your occupancy. You need to make sure that your occupancy is high. And if you're not doing something about your occupancy, you need to make sure that somebody else is on a daily basis. Because the higher your occupancy, the higher the amount of money that you're going to be making. And again, very similar to HMO, you're paying the bills. So an overview. If you look at the staycations that have been happening, the staycations have been very popular since people have been released from lockdown, haven't they? I know one serviced accommodation cottage, which is focused on the leisure market. I'd say about 75% of the income is generated from the leisure market and about 25% is commercial. They've been able to increase their prices from £1,000 a week to £5,000 a week because there's just such a high amount of demand. Now, that's how quickly that market can turn around. That's how quickly that market can update, because it is being sold by the week, or by the day, sorry, by the evening. So you can earn a huge amount of cash flow, or the potential is there for you to earn a huge amount of cash flow and the capital appreciation. So that sounds even better than HMO, right? Because you can ride this uptrend in the market where you're making a huge amount of money. And again, the investment is secured against the asset. And the rental income, in a lot of cases for serviced accommodation, is not only linked to the value of the property. And by value, I mean the bricks and mortar value. So you can find commercial agents or commercial lenders that will value the property based on the income that you're making and not just the bricks and mortar value. Now, there's a huge amount of caveats and there's a huge amount of additional information that you need to know about commercial mortgages, which every single source franchisee should know about because we go over it in a lot of detail when they come onto the induction training. But again, conveyancing process can be slow, and especially for serviced accommodation, there are few lenders in the market. Now, even fewer than there were, say, 24 months ago because of coronavirus. Because like I said at the very beginning of this, coronavirus basically killed the serviced accommodation market for a set period of time. People just were not allowed to use serviced accommodation at all for a set period of time. And because of that, lenders see it as more of a risk. And therefore, a lot of lenders have withdrawn from the serviced accommodation market. There are still lenders out there that will do it, but a lot of lenders have withdrawn. So if you look at borrowing money against the serviced accommodation unit, you've now got fewer choices. And when you've got fewer choices, what does that mean? Well, it means the price goes up. So the cost of borrowing is higher for serviced accommodation because there are fewer lenders in the marketplace. And also, the overview for serviced accommodation is that the rental market fluctuates, not only due to the market and the demand in the market, but also annually. You'll find that you make a huge amount of money in the summer if you've got if you're in an area that takes advantage of the leisure market, but over winter you're probably going to make less money, and therefore you need to be aware of how much money you're going to make in the different months, so you can cash flow properly for it. Because as with all businesses, cash flow is king. Now, in this one, there are only basically two markets that are providing your tenants for you. There's the commercial market and there's the leisure market. So if you see a property and you think, wow, that is absolutely stunning for serviced accommodation, and you haven't done your homework, and actually it's not quite right for the leisure market, and it's not quite right for the commercial market, then you can be in trouble with a low occupancy and therefore a higher risk that you're not covering your bills. So on average, serviced accommodation has a much higher chance or much higher ceiling price of what income you can earn from it. You can still create the capital uplift just as you could for HMO. And you can even, in the majority of the country, I'd say, find a managing agent who is going to manage that property for you. Now, with serviced accommodation, if you are thinking of doing it yourself, it's much more intense than running a HMO. Running serviced accommodation is a much more of a daily thing for you to be on top of. And if you are going to outsource that to a managing agent, then that means that managing agent is going to take that responsibility from you. And therefore, it's probably going to cost you more money. I'd say on average, a serviced accommodation agent is going to charge you between 15 and 20%, whereas for a HMO, you're probably looking at around 10% of your gross rent. But one of the other benefits, and this is what happens when people go on their staycations, is that they'll go somewhere lovely, they'll have a look around, and what do? I'm totally guilty of this, and I've done this in Cornwall because we went to Cornwall not very long ago. You look in the estate agent's window, you look at what's available, and you work out how much you're paying for what you're for the place that you're staying, and you work out that if that was extrapolated over the 52 weeks of the year, you'd be a millionaire by this time next year. Well, it doesn't work like that because the market fluctuates. But it does mean if you're going down the serviced accommodation route, you can block out certain weeks in order for you to take advantage of that property as well. But then you're always at that difficult decision, aren't you? Because the time that you probably want to use the property is over the summer holidays. And the time that you're going to make the most money from that property is over the summer holidays. So essentially, if you are renting out your property for £5,000, you're costing yourself £5,000 by you taking your holiday at that exact time. So although it sounds ideal that you're going to be able to use that property, you're probably not going to use it as much as you're first banking on, because you know that that's when you can make the most money out of that property. So when you're purchasing the property, because I said that we were going to talk about some of the lending options that you could get, you need to purchase and you need to refurbish the property. So you've got a couple of options for the way that you purchase and the way that you refurbish the property. So if you've got a good pot of money by your side, you can buy the property on a mortgage, you can do that refurbishment, you can refinance it onto another mortgage. Now, you need to make sure that you're compliant with the mortgage's terms and conditions, and you're not going to end up on the mortgage blacklist, because mortgages are not seen as the ideal way of borrowing for a short period of time and then refinancing. So if your plan is to purchase on a mortgage, like a 2-year fixed mortgage, and then refinance after 5 or 6 years, if that's compliant with the T's and C's, you're probably going to be okay doing that. However, if you're going to purchase on a mortgage and then refinance after 6 months after you've done the work, you're probably going to end up in trouble with the mortgage companies, and potentially you could find yourself blacklisted. Bridging finance is a way of borrowing on a short-term basis in order to allow you to do that, to take advantage of that refinance. Now, one of the things that people are going to tell you about bridging finance is that it's more expensive. And I completely agree, it is more expensive. However, if it gives you access to that refinance and that capital uplift sooner, you might work out over the course of the deal, over the lifespan of the deal, that actually it's cheaper for you to refinance quicker and then take advantage of that additional money that you've released. And this is the same for HMO, and it's the same for serviced accommodation. You can do both. And for both of them, you can actually get commercial mortgages. So with HMO, you can get a commercial mortgage. For serviced accommodation, you can get a commercial mortgage, both of which would be based on factors other than just the straightforward bricks and mortar value of that property. Does source capital compare? Well, source capital is a kind of bridging finance, so absolutely. And we finance deals like this for our franchisees, where we can provide them the money to purchase. We can even provide the money for them to refinance, and then they can remortgage the property, keep hold of it, add it to their portfolio, and potentially pay back any money that they've put in and pay back the first charge. Well, the first charge will come first, but then pay back any money that they've put in. So potentially add that property to their portfolio without actually costing them any money once they've refinanced. How do HMO and serviced accommodation mortgages compare? Well, over the last 24 months, 18 months, 24 months, because HMO has been a much more stable investment, the cost of a HMO mortgage is still more than a buy-to-let. I'd say it's around 4% at the moment per month. But serviced accommodation, because like I said before, you've got fewer lenders that are in the market, and therefore the monthly cost of a serviced accommodation mortgage is much higher. Now, I said that we were going to give you a sneak peek of our deal calculator, and this is our deal calculator. So every deal that a source franchisee brings to us for us to look at, whether it be serviced accommodation, whether it be HMO, comes into this deal calculator, so we can analyze it very quickly and efficiently. Now, we give the franchisees extensive training on this deal calculator, including videos that we show them that they can go back to and they can reference to help them understand how to use the deal calculator. This is a HMO that we're looking at here. And on this HMO, what we're doing is we're purchasing for £55,000. We've got all the costs involved in purchasing just down here. We're going to do a £30,000 refurbishment. We're going to look for a loan over 6 months. And that refinance is going to bring us out to £135,000 at the top here. This is a deal that actually got done, and these are the numbers from this deal being done. Now, that £135,000 is the GDV. And then what we're going to do, that's stage one, so the purchase and build. And in stage two, we're going to refinance that property. We're going to put it onto a mortgage. And this mortgage was at the interest rate of 3.89, based on a loan to value of 80%. And that's a capital repayment mortgage, not just an interest only mortgage. And that filters down here to show us what the costs of running that property are on a monthly basis, the income generated from that property. And again, this is all accurate data from a property that actually happened. And then we've got the metrics down here. So that property is generating nearly £1,500 per month for that franchisee. And that is, like I say, HMO specific. Now, the important thing to note here is that, well, one of the important things to note is that after the initial cost and refurbishment, once that was refinanced, in this box here, this is the number of how much money the franchisee still had in that deal after refinance. That's right, it is zero. So the franchisee purchased that property, they then refinanced the property, They pulled all of their money out of the property, and then they were making this cash flow of £1,500 per month. So they added that property to their portfolio. Effectively, after refinance, they pulled all their money out. They rebuilt their pot of money to go again to buy the next HMO, while they're still generating this 1,500 quid coming in every single month. That is absolutely the ideal situation for HMO. So there's zero left in that deal, 17,894 return per annum with an infinite return on capital employed. And that return on capital employed is my favorite metric to look at properties, the way, the effectiveness, the efficiency that properties are generating, because you can compare it to other investment classes, to other asset classes. So if you're looking at investing in the stock market on average over the last 10 years has returned about 7%. And that's a return on capital employed. This property is going to generate an infinite return on capital employed because the franchisee had no capital employed in that property. All of the money that they were making as the net was profit. Now, on top of that, you've then got the capital appreciation of the property of 11%. The market in that area, on average, over the previous 5 years, properties had gone up in price by 11%. So not only have you got that fantastic cash flow that's happening from that HMO, but you've also got 11% increase in that property. Now, this is a serviced accommodation block. This is a serviced accommodation, unit, not a block, to be absolutely accurate. And again, this has gone through the deal calculator. And the uplift of this property wasn't agreed. The surveyor that went to have a look at that property didn't agree that the serviced accommodation would be able to make that money. And so, again, what I'm doing is I'm giving you an actual example. And so the bricks and mortar value slightly went up on that property from £140,000 to £150,000, which meant that that franchisee, if they were going to do this deal, would have to leave in £80,000. Now, what that surveyor said was that they could not predict effectively what the serviced accommodation income would be, and that they would increase the value of that end value, the £150,000, if they could see evidence of how the serviced accommodation would perform. And you're much more likely to get that kind of comment from a valuer when you're looking at serviced accommodation, because it's much more of an unknown entity than HMO is, because from one street to the next, serviced accommodation can be different and can generate different incomes, whereas HMO is a bit more stable than that. So this valuer was saying, you know what, I can't give you a commercial value for this property until I can see what the rental income is. So you go and do that, and then after 12 months of showing me what the income that you're generating is, I'll then give you a commercial value. So what this person would have to do is they would have to run that property with that £80,000 invested in that property for a period of time for the 12 months, and then they might be able to refinance. So it's slightly different structure, much more common to service accommodation. So this is a question that I've just got in from James. So all sounds lovely, but how did they manage to buy the property at 20 or 25% under market value? To be honest, James, they used Facebook, and that was it. That was actually a deal that was generated from posting on Facebook. So that person posted on Facebook for a period of time, told people that they were involved in property, showed them examples of property deals that they were doing, asked if there was anything that anybody needed help with. And then one of their original friends, not somebody from within property, one of their original friends got in touch with them on Facebook and said, I've got a friend of mine is struggling to sell her property. It's a HMO, it needs refurbishment, it's in a real state. Can you help her sell it? So that person then went out to see that property and helped them with that property. And that was a case where the property had an outstanding mortgage of £55,000. And that person just wanted to get rid of the owner of the property, just wanted to get rid of it. They were not interested in it. It was just a headache for them. And so the franchisee offered them £55,000, which was the outstanding mortgage, which allowed them to walk away from the property. And that person said yes. It's all about network. It's all about building your contacts and talking to the right people. So that's how they did that one. So the returns for that one, they've got £80,000 left in the deal after refinance, and they're generating £18,000 per year. So they're generating roughly the same as the HMO, but instead of an infinite return, this one generates a 23% return. Now, 23% is still very, very healthy. You know, like we said, the stock market has generated about 7% return over the last 10 years. So this is very competitive in comparison to other investments. However, when you look at property as its own asset class, there is better. There is better out there. And that better, typically, time and time again, comes from HMO. So I've just had a question from Nick, who says, can an investor work directly with a local source franchisee to build their portfolio? Absolutely, yeah, you can. You can absolutely do that. You can work with that individual source franchisee to help you build your portfolio. Now, depending on how you structure the deals, you wouldn't have access to source capital, because source capital will only lend to our franchisees. So if you're going to be, if you're committed and you're going to be aggressive about the way that you want to build your portfolio, sourced HMO partner is definitely an option to help you scale your portfolio much quicker than you could potentially do it yourself. So on top of this deal, let me just say that this is going to be generate the 11% increase in capital value, just in the same way as the other one would as well. So like I explained to you, what is ROCE and why is it so different? So ROCE tells you the return on capital employed. That's what it stands for. And that's what I think is the most important thing when it comes to understanding how well your investment is operating. You know, traditionally, people have used yield to generate the investment metrics or the numbers, but yield doesn't tell you how well you're doing, how well your money is doing, because your yield might be terrible. You know, I just looked at a deal this morning, and the yield was 1%. And somebody said to me, well, that's a terrible deal. And I said, well, what's the return on capital? And the return on capital for that deal, genuinely, this happened this morning, was 33%. So in comparison to other asset classes, that's still a really good deal. If your money is working at 33%, that's still a good opportunity. Now, there might be better opportunities out there, and I would have to know a little bit more about that individual's circumstances as to exactly what they want to achieve out of their property investment. But for me, return on capital employed and how well my money is working is by far the most important metric. Just going to have another quick look at the chats. Yeah, okay, no worries, Nick. You're welcome. So risks and opportunities, let's have a look. So as with everything, there are, in an hour-long webinar, it can all sound very, very simple. It can all sound very straightforward. There are boxes that you need to tick, and there is legislation that you need to stick to. And if you don't understand that legislation, you could potentially end up in trouble. So for HMO, there is a higher level of legislation and planning in comparison to buy-to-let. So for example, Article 4. Now, I can mention Article 4, and you guys might have been on another webinar for somebody else talking about HMO, and you might sort of understand that HMO restricts whether you can build a HMO. Article 4 restricts whether you can build a HMO in a specific area. But that is not what Article 4 means. Article 4 is the removal of a permitted development right. And again, you've got to go into the next level of understanding what permitted development rights are and how they reflect to HMO as to whether that can actually stop you building HMOs. I'll give you an example. There's an Article 4 area in a very popular northwestern town called Morecambe. There's an Article 4 area in Morecambe. It's right on the seafront there, right in the prime sort of big Victorian houses that are exactly right for turning into HMOs. There's an Article 4 area there. And a lot of people in property will look at that and they'll see that Article 4 area and they'll say, oh, no, can't build there, can't turn a property into a HMO there. Let's look somewhere else. But actually, if you look at the details of that Article 4 area, what that Article 4 area does is it stops people making external changes to their houses without going through planning. So if you want to change your windows or if you want to change the color of your house, you can't do that in that Article 4 area. You can build a HMO there. You can turn a normal property into a HMO, absolutely no problem at all, because that Article 4 area does not reflect HMO, the permitted development that allows you to turn a normal property into a HMO. That Article 4 area is relevant to a different permitted development for normal exterior housing changes. So That's just one example of how the majority of people misunderstand what part of HMO legislation is. And it's very important that you understand this, because you don't want to get yourself in a position where you have built a HMO, you've had a problem with that HMO, for example, with the council, or even that HMO setting on fire or something horrific, and then you find out that you weren't compliant. That is not the structure. That is not the right way to do it. You need to understand exactly what you're getting yourself in for. With HMO, there are fewer mortgage providers in comparison to buy-to-let. But like I said, across the market, there are still a lot of mortgage providers that are looking for HMO as a stable opportunity for them to lend against. So larger deposits might be required for first-time landlords, and HMO-specific lending companies might require you to have HMO experience in order to qualify for their product. Now, again, we see this across our franchisees. We help them come up with ways that they can mitigate for that kind of problem in order to start their portfolio and not only build their portfolio. There could be high startup costs for not only the conversion of the property, but you might need to buy furniture. You might need to do more work for the regulatory legislation as well, such as fire doors, fire alarms, additional bathrooms, that kind of emergency lighting, that kind of thing. So it's really important to be able to budget for that before you start the conversion. Now, there are fewer letting agents around the country that will take those properties on, but that's, again, in comparison to buy-to-let. And what you're seeing across the board is that more and more letting agencies will now take on HMOs because they can see that it's not just a flash in the pan. It's a solution for housing that is going to be around for a long period of time. And so letting agents see it as another string to their bow in order to look after HMO. Capital growth can potentially be lower on HMOs due to the resale market consisting mainly of specialised landlords. Now, that again depends on the way that you're going to structure it. And again, what we would do at Sourced is we would make sure that we understand not only what you want to buy, but the purpose of why you're buying it and how that fits in with your long-term goals. Because we're not just looking at, satisfying your thirst for buying a property quickly. We're looking at how that links and how that works in building and scaling your portfolio over the next 5, 10, 15, 20 years. So we need to make sure that that property fits with you and how you're going to hold on to it, and how you're going to structure that property and how it fits with the rest of your portfolio. Because the way that you finance it can be different, because the way that you finance it can be different risk profiles would suit the way that you finance that property much better. We'd get in-depth knowledge about exactly what you're trying to do and exactly how you're trying to do it before we start to look at the ways that we're going to structure different property deals. So not every property can work as a HMO as well. So therefore, the number of suitable properties in the area can be limited. Now, one of the things that we've just launched recently for our franchisees is a lead generation system called Escudo. And what we do is we go through every single property that's put onto the market and we analyze that for floor plans, for layouts, for bedroom sizes, for costs, for local HMO housing costs. And we analyze that digitally so we can then pass on the opportunities to the franchisees that work the best, which means that instead of our franchisees having to trawl through Rightmove or trawl through Zoopla, they can just look into their CRM system. They can see the properties that have popped through to them and they can analyze them. And they might have 5 or 6 per week, for example. And that's far more efficient analyzing those 5 or 6 per week than it is analyzing 100, 200, 300 properties that are put onto the market from Rightmove, Zoopla. So the opportunities, like we've talked about, the rental income for HMO is far better than buy-to-let. The risk of a void period is much lower and much less impactful for HMO than it is for a normal buy-to-let, because if one room is empty, it doesn't have such a financial impact on you as it would in a buy-to-let. But my argument for that is that you should have done your research so well that you're pretty certain that you're not going to have those void periods. There are ways to analyze the local demand in an area to make sure that you're going to fill that room within the 4 weeks that you need to turn around that room in, because as soon as a tenant gives you notice, you've got 4 weeks before they've got to give you a 4-week notice period. So you need to fill that room within 4 weeks. And if you've done your research correctly, you should be making that turnaround within 4 weeks every single time. The quickest ever I turned a room around in was about 17 minutes. 12, I can't remember actually. Was it 12 minutes or 17 minutes? Off the top of my head, I can't remember. I have got it written down somewhere. And essentially one person vacated the room, went into the, put all their stuff in the car, sat in the sitting room, waited for me to come and do the checkout. I did the checkout, sent the cleaner in. The cleaner cleaned the room thoroughly. And then the next person arrived 12 minutes later as the cleaner was still sorting everything out. And I did the check-in with the next person 12 or 17 minutes later. That's the situation that you want to be in. Now, I was managing that property myself, but if I was going to employ somebody to manage that HMO for me, I would want them working to the same kind of standards. So the costs that you lay out on a HMO, pretty much all of it is tax deductible because you're running it as part of your property business. And a commercial valuation for certain types of HMO is much more likely from the initial valuation, not just the, like for serviced accommodation, not just that valuer going there and saying, well, run it for 12 months and then I might give you a commercial valuation at that point. Again, let me just be absolutely clear. A commercial valuation isn't the way forward in some cases, but it is something that you need to seriously think about as a way of building and scaling your portfolio much quicker. There are pros and cons to commercial valuations. This is not the time to talk about it because we only have about an hour, but it's something that certainly you should look into, and we go through very thoroughly with all of our franchisees. So serviced accommodation risks, let me just start on that top one, because this is one that I was asked a lot when we were selling serviced accommodation units. Easy to misunderstand the correct planning use, because you've got a couple of different ways of using the use classes for serviced accommodation. And actually, serviced accommodation can be use class C3 or C1, depending on the situation of that serviced accommodation, depending on the title, depending on the number of units. It's very easy to misunderstand exactly the right way to do it. And actually, we've got a situation at the moment with a council in the UK where they don't understand what the difference is in serviced accommodation planning. So the way that we're approaching that is that we're suggesting to the franchisee that they get it in writing from the council, that the way that they're doing it is approved, even though it's not going through the planning system, because technically they don't need to change the planning on that property. We still want confirmation from the council that they're okay with the way that it's being done. So it's not just from an individual's point of view. Councils still don't understand how to run serviced accommodation correctly. So there are fewer mortgage providers, like I talked to you about before, not only compared to buy-to-let, but also compared to HMO. Again, you might need larger deposits. On the two deal calculators that I showed you, you're going to need a deposit of at least £80,000 in order to build that serviced accommodation out as serviced accommodation and get it running, which essentially gives you higher startup costs. There are fewer letting agents willing to take on serviced accommodation, not only opposed to buy-to-let, but also in comparison to HMO as well. So even more difficult to get them running. The commercial valuation is less likely unless you're buying blocks, because a block of serviced accommodation units is seen as more of a commercial entity than just one unit on its own. But then if you're buying blocks, or if you're buying lots of properties in blocks, the lease that is on that block can prohibit you using those properties as serviced accommodation. We see that a lot, especially with newer blocks. This tends to be built into the leases of a lot of blocks, that serviced accommodation or short-term rents are not allowed, and therefore that would be thrown out straight away. Obviously, if you're the freeholder, that isn't so much of an issue. But if you're the freeholder, you're probably only looking at one property instead of multiple properties. And if you're only looking at one property, then we go back to the issue with the commercial valuation. Income produced by SA is liable to VAT. Now, this is something that can take some people by surprise, but the income that you generate from a HMO is rent. The income that you generate from serviced accommodation is not classed as rent. And if it's not classed as rent, it is liable to VAT. Again, there are things that you can do to mitigate for this. However, it is something that you need to think about when you're setting up the business, not when you hit that £85,000 threshold. You need to understand this and work out how you're going to incorporate that risk into your service accommodation business before day one, before you buy the property. So you need to be aware of it and to understand it and mitigate that. And then much more so than HMOs, demand can fluctuate. You know, we've seen this over the last 18 months. Demand has been, before the coronavirus, staycations were still popular. Demand was very good. Since we've come out of lockdown, demand is extremely good. But during lockdown, demand wasn't there because people weren't allowed to take those units up on short-term rents. And so people had to, you know, I know people that were running serviced accommodation as rent-to-rent service accommodation who just had to hand the units back. But if you've bought the unit, you're not so able to hand that back. You need to come up with a plan B. What is your plan B in order to mitigate for that market fluctuation? Now, because of those risks, there's obviously got to be a benefit. And the benefit is that income can be much higher on service accommodation than it can be for HMO, I would say. But you're taking that risk because you're taking the responsibility of the downside if it doesn't go your way. There's less risk of void periods. That's not quite right. I think that's come over from the HMO side. Apologies for that. The property is still available to use for you. Obviously, if you've got a HMO and you've got tenants in there, you can't use that property. With serviced accommodation, when those tenants move out, you can take over that property and you can use it for your use. You've got less chance of rental arrears because you can, you know, if you're working your serviced accommodation hard, you can manipulate the cost of that serviced accommodation in order to make yourself competitive on the local portal. So if you're using Airbnb, if you're using Booking.com, you can reduce your rates very, very close to when you need the property filling, and chances are you are going to be able to fill that. Obviously, your income would suffer, but you can make sure that you are not running any void periods. So on average, across the two different categories, higher costs of running your property. Well, serviced accommodation are going to have higher costs. Capital growth across the two, well, probably they're going to be exactly the same because capital growth will depend on the market, the local market. And so HMO and serviced accommodation come out equal on that one. Potential higher rental income, it's probably going to be serviced accommodation again because you have got the chance of higher income. Potential lower income, well, I'm afraid serviced accommodation is going to win that one as well because, like I said, it's much more susceptible to market fluctuations. Higher workload for the property, again, that's going to be serviced accommodation. It takes more effort to run serviced accommodation than it does for HMO. And more certainty, you're looking at HMO. And you know, from my point of view, if I was going to choose one for that certainty and for that the ability to run that HMO with less effort than serviced accommodation, I would absolutely choose HMO every single time. So let's have a look at a couple of success stories. So we got Neeraj, who is one of our franchisees, and he grew his HMO portfolio to 195 rooms. So he's incredibly experienced at running HMOs, and he had only 3 properties that had void periods. So that's going back to what I said about demand. Understanding the demand and understanding how quickly you can fill rooms that become empty is the way of making sure that you've got a high occupancy and high income from HMOs. Now, these were these numbers he achieved from basically investing in the HMOs that he'd already built, as well as adding to his own. And he repurposed his student HMOs into professional HMOs. So like I said, if demand in one area goes down, you've got another couple of options with your marketplace in which to invest in and in which to target to make sure that your rental income is stable. So his expectations for 2021, he's going to expect a lot more deals. He's going to see that the market is changing and they're reducing their lending to 65% to start off with on a loan to value basis for borrowing against HMOs. But that, I would predict, is going to recover fairly quickly in the second half of this year. There's lots of people out there that can invest in cash that want to put their money into HMOs. And he's looking to grow his portfolio by about 15%. This is Jason, who has been running serviced accommodation, and he's been running serviced accommodation since before he joined Sourced on a rent-to-rent basis. But what he wanted to do was start buying his own serviced accommodation, and that's why he joined Sourced, in order to take advantage of Sourced capital. So he's been running serviced accommodation for a while, and he's been using local managing agents in order to outsource the running of his serviced accommodation. So that frees his time up to focus on building his portfolio. He's going to see a massive demand for serviced accommodation over the next 2 years. I completely agree with that. The question that I would be asking, because when you're buying a property, you don't tend to buy a property for just 2 years, especially if you're looking at the rental income as the main purpose of buying that property. However, what's going to happen after 2 years? At what level is it going to fall back to? Are we going to see sort of a dip after 2 years' time when people are more used to going abroad on holiday again? And, putting your ankles into the Mediterranean Sea is a lot more pleasant than putting your ankles into the North Sea. I did that this weekend, and it is still very cold. I can remind you of that. So what's going to happen after that? And does Jason have a plan B? Now, this is obviously something that we've talked to Jason about, but from your point of view, you need to do exactly the same thing and consider the risks involved in serviced accommodation when you're putting your plan together. So what we do, we are focusing on HMO as an option. If you're looking to build your portfolio, we can absolutely help you do that. And we would focus on HMO as a way of taking the best out of all situations and providing you, based on historic data, providing you more certainty of that rental income going forward. And so what we do is, with the HMO partner side of our business, we provide you with training, we provide you with step-by-step support, we provide you with the proven structures and examples of the ways that we've structured deals in the past to allow you to learn and how you can make deals happen in the future that potentially previously you weren't aware of. We handpick HMO opportunities for you as well, so that you can see and you can make your time very efficient when you're analyzing the deals. You can see what deals work on a much higher efficiency rating than just scrolling through Rightmove, scrolling through Zoopla and doing all of that donkey work. And then through Sourced Capital, we can provide up to 100% funding on the purchase and development costs to help you purchase that HMO, add it to your portfolio, and take advantage of that rental income. So the training events that we're putting on for our HMO partners include the initial induction, where we teach you about what we're doing, our CRM system, our deal calculator, all of that in-depth stuff that you need to know about in order to analyze the deals quickly and efficiently. And we give you an overview in HMO, including like the Article 4 stuff that we talked about earlier. And then we have some other training courses which goes into each area of finding, purchasing, and running a HMO into a lot more detail. So sourcing, structuring, lettings, planning, and then the refurbishment and conversion. The HMO introduction is compulsory. We run that every other month. And then all the other training days, it is completely up to you as to whether you want to jump onto those training days or not. So with the support, we actually have a support team in place. But back in the day that I did the support, this is me talking to one of our franchisees and putting a plan in place for how they're going to build their portfolio. And so the photograph previously was just after they'd started. And then the next photograph is of, it sounds really old fashioned to call it a photograph actually, doesn't it? The next image is of us, me and the managing director of the company, Steve. We're sitting down with one of our franchisees to look at a very complex deal that he didn't have any experience of looking at and breaking down and structuring. So we sat down with him in order to help him understand the right way to structure that deal in order to be very competitive and secure that deal as quickly as he possibly could. So in order to be part of Sourced, there is a fee because it's a franchise. And so what do you get for being part of Sourced, and what do you get for the fee? So obviously you have the backing of us. We are building an incredibly well-known and trusted brand across the UK. We've obviously got expert industry knowledge to help you avoid costly mistakes, especially when it comes to HMO, especially with the licensing, the legislation, the planning. You need to know exactly what you're doing in order to structure your deal as quickly and as efficiently as you can, so that you're able to add that to your portfolio without any nasty headaches further down the line. we've got the extensive training schedule. And the way that we look at training is, we're not trying to upsell you into a different training course. What we say is once you're part of our community, you get access to the information. So anything that you want to know about HMOs, we will give to you. We put it all in the HMO training courses because we want you to analyze the deals exactly how we would analyze the deals as quickly as we possibly can. We've got the funding facility of Source Capital, which can lend you up to 100% of the funding. And then we've got comprehensive support and mentoring to make sure that when you're looking at deals, when you need more deals coming across your path, you can talk to your support person, you can talk to your mentor, and they will help you achieve exactly that. Now, to come on to be one of the Source franchisees, it will cost you £12,500, and that gets you into the franchise network for a period of 5 years. We then have a license fee, the management fee, which is paid monthly, and that makes sure that we can help provide you exactly the same service through the life of your time with Sourced. So we'll help you with tenant support, we'll help you with off-market HMO opportunities. We're always there for you if you've got any questions about something specific that you have no experience of. We provide you with a CRM system that helps manage not only your organization of the properties that you're looking at, but also the communication through HQ, because you can do that through your CRM system. You've got the comprehensive training, and those training courses, if you want to come onto the sourcing training course, you absolutely can. But then 12 months later, if you want to come onto that sourcing training course again, you absolutely can. There is no additional fee for that. You've got access to the ongoing access to the peer-to-peer platform, and you've got that dedicated mentor. You've got a huge amount of development resources. You've got templates, you've got contracts, you've got finance calculators, you've got a huge amount of resource available to you in the CRM system. And then you've got legal documents as well, which we've used. You can use as reference points to understand how things are going to work. So that's £200 per month. And then for every HMO that you add to your portfolio, that would go up by £50 per month. But that's only when you have already started to make money. Now, what we would suggest is the minimum sort of investment that you would have available to you in order to start to grow your HMO portfolio as quickly as possible would be that you have a pot of £100,000 if you're going to invest in the north of England, £200,000 if you're going to invest in the Midlands, and £300,000 if you're going to invest and build your portfolio in the south of England. So that's the end of the presentation. I will stick around for a few minutes if you've got any questions that you want to shoot over to me. I'll just remind you to please put them in the Q&A box. And if you've got any questions that you think of in the future, then please use the email address lindsay.irving@source.co. And Lindsay, who works here at Source HQ, will be able to answer all of your questions and provide you any help and support that you have with regard to the franchise or with regard to any of the HMO stuff that I've covered previously on this presentation. So just looking at the Q&A box now, I can see that there's no questions in there. So I will jump off and I will say thank you once again for spending your Tuesday afternoon with me. Oh, no, got one. Let's go to it. To facilitate funding for an SA, would it be better to let on ASTs? To facilitate funding for SA depends on what kind of funding that you're going to go for. If you're going to go for commercial finance or if you're going to go for bricks and mortar finance. Now, if you're going to let it out on ASTs, you're probably not going to achieve commercial finance for that serviced accommodation that you can if you're letting out on the commercial basis of serviced accommodation. Also, you would be causing yourself other problems if you are letting out on a short-term basis and you're letting it out as an assured tenancy. So there's a lot of issues that you would have legally with that if you get found out. There's a lot of issues, not only legally, but also financial from a HMRC point of view as well. So it depends what you're trying to achieve. I think that is a great example of where you can come up with a solution that actually might be creating more of a headache for yourself 12 months down the line. I've got another question. Okay, so if you don't have that kind of initial investment, then we cannot do this. So if you want to be a HMO partner, then yeah, that's absolutely right. We would we only select people that we know have got the right financial capability to build their HMO portfolio quickly and efficiently. They're the kind of people that we want to work with. Now, if you are interested in investing in property, the other side of our business, the network side of our business, the network franchise, might be for you. Now, you would need, it's a similar price, but you would need no initial pot in order to join the network. Because what we're looking at from the network side of the business is not just that you're focusing on building your HMO portfolio, but you're just making money out of property. So Mia, if you go to our website and you look at the other half of our franchise, the network side of our franchise, that might be an option for you. But certainly for the HMO partner side of the franchise, we're only looking to work with people that have got that initial investment. So I can see, got one more question in the chat box. You are very welcome. Thank you for thanking me for the presentation. You're very welcome, KO, and thank you for saying so. And if you've got any questions, please get in touch. But at that point, guys, thanks very much for spending the afternoon with me. And please use the email address below if you've got any further questions, and I'll speak to you soon. Thanks a lot. Goodbye.